Well, hello there, and welcome to this short online lecture where I'm going to be talking a little bit about depreciation. I hope you're very well. Well, my name's Gareth. I'm a managing director with First Intuition, one of the UK's premier accountancy training colleges. If you've got any questions, you're more than welcome to get in touch with me. I teach a wide variety of different AAT papers. I also teach other qualifications, so if you've got interest in moving on after AAT to things like ACCA or CIMA or Chartered Accountancy, I can probably answer questions on those sorts of things, and I can also give general advice on studying and trying to learn things. So feel free to get in touch. My email address is garethjohn@fi.co.uk. And you'll be in safe hands. In the last few years we've done very well as we've grown our business. We won UK Accountancy College of the Year in both 2010 and 2012. I was extremely proud to be awarded UK Accountancy Lecturer of the Year in 2011, and more recently we were nominated for Study Resource of the Year in 2013. Well, let's have a little look here at depreciation. So we've got an example we're going to work through here. Got a machine bought for £50,000, so that's the capital expenditure on the machine. Got an expected useful life of 4 years with an expected residual value. So this is what we think we're going to be able to sell the machine for at the end of the 4 years, of £5,000. And we're going to show the ledger accounts, or the T accounts, for the first 2 years here of owning this machine. And in particular, we're going to be interested in the T account for the non-current asset costs. So that would be the asset that will ultimately be reflected on the balance sheet. We've got a T account for the depreciation expense, or the depreciation charge. That's going to be the expense that will hit our profit for the period. And an accumulated depreciation T account. And what we're going to see is that that accumulated depreciation T account effectively gets netted off against the asset cost, because when we're actually showing the asset on our balance sheet or on our statement of financial position, we're going to always show the net book value. And what we're going to see is the net book value figure will be the net, literally, of the cost and the accumulated depreciation. So we're going to look at how the ledger accounts would work for the first 2 years, and we're going to then think about how the relevant figures will be shown in the financial statements for each of these first 2 years. So thinking about how it'll impact on the statement of profit or loss, or the P&L as it's often referred, and how it'll be affected in the statement of financial position, or the balance sheet, as people sometimes call it. So our two key financial statements, we'll think about how these numbers would be shown in our accounts at the year end. Okay, well, the first thing we need to really do is start thinking about what type of depreciation we're dealing with, because there are two different ways of working out depreciation. There's the so-called straight line method. Now, the straight line method is where we base the depreciation on the original cost of the asset. And then we've got the reducing balance depreciation method, and with reducing balance we actually base the depreciation on the net book value. So with straight line it's based on the cost, and with reducing balance it's based on the net book value. And what you can perhaps therefore imagine is that because the cost is always the same, the cost you spent on the asset originally never changes, with straight line depreciation we'll end up with the same depreciation each year. Whereas with reducing balance, because that's based on the net book value, and the net book value will be falling each year, so will the depreciation. We'll get a lower depreciation charge year by year by year. That's why it's called reducing balance. So straight line we get the same depreciation every year. Reducing balance we get a reducing depreciation each year. Well, what does it appear we're dealing with here? Well, in order to use reducing balance depreciation, you would have to be given a percentage figure. You'd have to be given the reducing balance percentage that we're going to apply to the net book value. And you can see in the example here we've got no sign at all of any percentage depreciation figures. So I'm thinking here we must be using straight line. Now, the way we work out the depreciation under straight line, let's just think about how the calculation works. We take the initial cost that we're spending on the asset, but we knock off any residual value, because the residual value is an amount we're going to get back, and we divide that over the number of years we're going to own the asset, or the useful economic life of the asset. So for instance, in our example here, you can see we're going to spend £50,000 on the machine, but at the end of the 4 years we're going to get £5,000 back from selling it. Now that means it's really going to cost us £45,000 to own that asset. Can you see we're losing £45,000, and we're losing that over a 4-year useful life. And one way to think of the straight line depreciation method is you're just evenly spreading the cost of owning the asset over the years that it's going to be owned for. Well, the 45,000 cost I'm suffering divided by 4 years, I get that coming to £11,250 per annum. And remember, the whole point of straight line depreciation is we're going to have that same depreciation cost in each of the 4 years that we own the asset. And in fact, depreciation, you may have come across the accounting concepts, and a key accounting concept is the accruals concept. And in fact, depreciation is a very good example of the accruals concept, because one aspect of the accruals concept is that we try to match transactions to the appropriate periods. So here we're just matching some of the cost of owning this asset to each year that we're going to own the asset in. You know, we're losing £45,000 here. Wouldn't seem reasonable to recognise that entire £45,000 cost in the first year. We're going to own the asset for 4 years, aren't we? So you can see we're effectively just spreading the cost out over the 4 years here. So we now know what we're going to be charging each year for depreciation. Well, let's now think about the double entry that we would therefore be posting. So double entry, obviously going to have a debit and a credit that will balance. Now the double entry for posting depreciation in each of the years is going to be debit the depreciation expense, or the depreciation charge. That's the cost or the expense that's going to hit our P&L. That will be 11,250, and that's a debit entry because you would expect expenses to be debit entries. And we credit the accumulated depreciation by the same 11,250. Obviously my double entry needs to balance, and that credit entry that we're posting, what we're going to see is that's ultimately going to be reducing the value of the asset on the balance sheet. So what you can imagine is that the expense is going to hit the P&L. That's what's reducing my profit for the period, hence a debit balance, whereas the accumulated depreciation account is going to impact on the balance sheet. That's going to be reducing the cost to give us our net book value. So that's the double entry we'll be posting, and because it's straight line depreciation, we'd be posting the same double entry each year. Well, let's now start thinking about our ledger accounts, or T accounts, that we're going to need to keep track of. And we're told that we're going to need 3 ledger accounts to record our information here. And as we think about these ledger accounts, we'll also consider how the figures are then going to be shown in the financial statements. Well, I've set up my necessary ledger accounts here. So we've got the non-current asset cost. Obviously, we've got a machine here. That machine is going to need to be shown on the balance sheet as an asset of the business, and given that I'm going to own the machine for several years, that would be treated as a non-current asset, an asset I'm going to own basically for more than a year. We've got a depreciation expense ledger account showing the cost we're going to suffer in our P&L, and we've got the accumulated depreciation ledger account. Now, when I'm dealing with T accounts, I always like to make it very clear to myself which of the financial statements the ledger account is going to impact on. So, for instance, with our non-current asset cost account, that's a balance sheet T account because the asset would ultimately sit on the balance sheet. The depreciation expense is a P&L ledger account because that will impact on the profit. So just like if we had rent expense or telephone expense, that will affect our profit for the period. And remember, the accumulated depreciation is also a balance sheet ledger account because that will ultimately be reducing the net book value that we're showing for the asset. And particularly don't confuse the depreciation expense with the accumulated depreciation. Obviously the names sound fairly similar, so just be very clear in your head which is which. Now let's just think about the basic double entry for the initial acquisition of the asset here. So before we even worry about the depreciation, we've got to think about the fact that we are buying an asset here for £50,000. And so on the first day of the ownership of the asset, we would have to capitalise that machine. We'd actually have to capitalise it as a non-current asset. Now the basic double entry for capitalising a machine or a car or computer equipment, any non-current asset, well, we need to show the asset, and that's going to be with a debit entry to the non-current asset cost. So I'm going to debit the non-current asset cost account. That's bringing the asset into the accounts of the business. Now the other side of that double entry, well, let's say it might be going to the cash T account. Let's say we paid the 50,000 in cash, so we would have a credit entry in the cash T account to reduce the asset of our cash balance. If we hadn't actually paid for the machine, the credit would have to go to a liability, some kind of payables balance to show that we still owe for the machine, but I'm not really interested in the credit side. I'm just interested in the fact that I'm debiting the non-current asset cost account. And let's say that that might be on the 1st of January of the first year. Let's say we buy the machine right at the beginning of the first year here. So I've now got the value of £50,000 sitting as an asset in my ledger. Thing is, the value of that asset will not still be £50,000 a year later or 2 years later or 3 years later. Assets wear out, they become old, they become more decrepit, they wear out, they become damaged, and this is the whole point of depreciation, is we're starting to reflect the reduction in value. Now we know in our example here that after 4 years that machine isn't going to be worth anything like £50,000, it's only going to be worth £5,000 after 4 years. And so we're going to start reflecting that reduction in value through our annual depreciation charge. So if at the beginning of the first year we capitalise the asset, at the end of the second year we would post a journal to reflect the first year's depreciation. And we've already assessed what the double entry would be. We're going to debit the depreciation expense and credit the accumulated depreciation, and we're going to do it for the 11,250, basically spreading the 45,000 loss over 4 years. So at the end of the first year, so let's say this would be 31st of December of the first year, we would charge as a debit to the expense account the first year's 11,250. And in terms of the narrative, this will tell us where the other side's going to do. So if I just abbreviate here, accumulated depreciation, because the credit side is going to go to accumulate depreciation. So this is the 31st of December of the first year again. And as a narrative, I'll put depreciation expense. So that's my balancing double entry at the end of the first year, charging my first year's depreciation, debit the expense, credit the accumulated depreciation. Now what we would then do, and imagine that's all we've done in the year, so we've capitalised the asset and then we've posted the depreciation. Well, in order to get figures for our year-end financial statements, we'd have to balance off each of our T accounts. Now if I start with the cost T account, to balance up, well, if you look at the debit and the credit side, we only had a figure on the debit side, the 50,000, so that goes in both totals. We therefore need a balancing figure, in this case the same 50,000. Now this is where it's particularly important that you think about whether you're dealing with a balance sheet or a P&L ledger account. The fact this is a balance sheet ledger account means that that £50,000 would be carried forward to the following year. You can imagine with things on the balance sheet, if you own a machine at the end of the first year, you'll still own that machine at the beginning of the second year. So that balancing figure becomes, and this would be the 1st of January of XD2, the second year, we'd have our brought forward figure of that 50,000. We still own the machine, don't we? So with balance sheet ledger accounts, the balancing figures gets carried down to the following year. But with P&L T accounts, so if I start looking at the depreciation expense, well again if you look at the two sides, I've got the 11,250 on the debit side, so I need that same figure on both totals. I then need a balancing figure, which again will be 11,250 here, but because this is a P&L T account, that figure is going to be cleared off to the P&L for the Remember, with expenses, and this isn't just depreciation expenses, this would affect rent expenses, telephone expenses, you only build up the expense for that one period, and then that will get cleared off to the P&L, so that in the following period you start from nil. You can imagine just because you've suffered an expense in the first year, that doesn't necessarily mean you're going to suffer an expense in the second year. So that balancing figure gets cleared to the P&L. Now this is rather different when we come to the accumulated depreciation ledger account. Now this time you can see we've got the 11,250 on the credit side, but again I put the same figure on both totals. This time my balancing figure is therefore 11,250 on the debit side, but because this is now a balance sheet ledger account, that gets carried forward. That's going to be carried forward onto the credit side, so this would be at the beginning of XD2 again. We have a brought forward figure of the 11,250. So notice the different treatments there between what we had in the depreciation expense ledger account. We had a balancing figure on the credit side that will get cleared off to the P&L, and that ledger account will start from zero again in the following year. Whereas with the accumulated depreciation account, we have the balancing figure on the debit side, that gets carried down to the following year. Things on the balance sheet get carried from one year to the next. Well, let's now think, and let's just pause at that point, because that's effectively the first year. We've capitalised the asset, we've posted the first year's depreciation double entry, and we've now balanced off all the T accounts. We can now think about how these figures would be shown in our financial statements. Well, in our statement of profit or loss, or the P&L, if we think about the first year to start with, now obviously we're just interested in how the depreciation would be shown in the P&L, so there would be all sorts of other figures in your P&L. You'd have a sales figure presumably, knock off cost of sales would give you your gross profit. You then start knocking off all your various expenses such as rent expense, telephone expense, electricity expense, salary expense, all the various expenses of the business, including some depreciation. Now, what's the depreciation expense for the period? Well, if you remember, we said that the amount that's going to get cleared to the P&L is the 11,250. Literally that first year's depreciation expense. So that would feature as an expense in the P&L, reducing our profit along with all of the other expenses and allowing us to work out the net profit of the business. So that would be how the first year's depreciation expense is shown in the P&L. In terms of what goes on the balance sheet, now with the balance sheet, we're thinking about the non-current asset figure at the very top of the balance sheet. You then have all sorts of other elements, your current assets like inventory, you'd have current liabilities and everything else, but we're just interested in the non-current assets. Now if you remember going back to our ledger accounts, the original cost we capitalised was £50,000. Is it reasonable though now to show the £50,000 as the value of this asset? Well, no. Because it's older now, it's a year older now, it's lost some value. So what we do with the net book value of the asset is we offset the accumulated depreciation. Yes, we paid £50,000 for the asset, but we've already said that it's lost 11,250 of value. So when we're actually showing that figure on the balance sheet, the reason it's called net book value is we literally need to net off the original cost that we've still got sitting there and the accumulated depreciation. If you think the cost is a debit balance, that's the asset, but the accumulated depreciation was a credit balance, wasn't it? So that's reducing the asset value. So if I knock that off, I get a net book value at the end of the first year of 38,750. So you can see it's fallen from the original 50,000, and how much has it fallen? Well, it's fallen by the 11,250 that we've shown as the expense for the period. So that's the end of the first year, but we're also thinking about the second year here. So if I go back to my ledger accounts, Now, what double entry will I be posting in the second year? Well, you can imagine I don't need to post the capitalisation of the asset. I'm not buying the machine again. I already own it. Remember, that's why we've got the brought forward balance already at the beginning of the second year. We've already got the 50,000 cost, so we don't need to worry about posting the 50,000 again. That's already sitting there. But what we do need to post is the second year's depreciation charge, and it's actually going to be exactly the same double entry. Remember, with straight line, it is the same charge each year. So I'm going to now debit the depreciation expense and credit the accumulated depreciation. I'm just doing this now at the end of the second year. Now, if we look at the impact that has, if I now, and this is at the end of the second year, remember, I now post the 11,250 of the debit to the depreciation expense. The other side of that's going to go to the accumulated depreciation. But the thing to remember is, because back in the first year, do you remember when we did the balancing figure, we cleared the depreciation expense off to nil. So therefore, at the beginning of the second year, there was nothing sitting in the account. So you can see this 11,250 is now there on its own. Whereas if you look at the accumulated depreciation account, where we now post the credit, so this is at the 31st of December of XD2. Now the other side's just gone to the depreciation expense, but can you see when we now post the credit to the accumulated depreciation, there was already 11,250 sitting there, because the balancing figure from the first year got carried down, didn't it? On the P&L, the balancing figure gets cleared off and you start from zero again, but with the balance sheet you carry it down. This is why it's called accumulated depreciation, because we've already got 11,250 from the first year. We're now adding on another 11,250 for the second year. So that's the double entry now posted for year 2. We've got debit the expense, credit the accumulated depreciation. We would then balance off our T accounts in the same way that we did at the end of the first year. Now, on the cost T account, you can hopefully see that when we balance it off, again, we've just got the 50,000 on the debit side, so I put that in both sides and both totals. My balancing figure is therefore still 50,000. I've still got the same machine that originally cost me 50,000. Because this is on the balance sheet, that gets carried down, so that would actually get brought forward at the beginning of the third year. So in fact, as long as I own that machine, you can imagine the cost is still sitting there at 50,000. If I then balance off the expense, well, remember, because we cleared off the first year's figure to the P&L, we've now just got the second year's 11,250. So in fact, the balancing figure for the second year is also 11,250, which again will get cleared off to the P&L account. So I'm hoping what you can see on the expense ledger account is you only ever get 1 year's expense at a time. Because the T account gets cleared off to nil each year, you're only ever going to have the single year's charge. Whereas if you then balance off the accumulated depreciation, well, we've actually now got 2 years worth there. We already had 11,250. We've just posted a second 11,250. So I now need 22,500 in my two totals, giving me a balancing figure of 22,500. And again, because this is a balance sheet T account, that figure would now be carried forward. You can imagine at the beginning of the third year, our brought forward balance is now 22,500. Can you see the way it's building up year by year? So that's called accumulated depreciation. So we've now got 2 years worth of depreciation in there. Well, how do these figures therefore get shown in our financial statements? Well, again, from the P&L T account for the expense, we've just got the 1 year's expense. So in fact, if I look at the statement of profit or loss, and again, we'd have some sales, some cost of sales giving us gross profit, we'd probably have some rent expense, but we've now just got the second year's expense to recognise, and then we'd probably have other expenses like telephone to take us down to net profit. But can you see that the depreciation expense in the P&L is only 1 year's expense at a time? Just the 11,250. And that's really my accruals concept. That's this accruals concept of recognising 1 year's worth of expense in each year. You can imagine actually in year 3 I'd be recognising the same 11,250. In year 4 I'd be recognising the same 11,250. So I am nicely spreading the £45,000 cost of owning the machine over 4 years, aren't I? So the P&L only shows 1 year's expense at a time. But when we come to the balance sheet, we now want the net book value. Now remember, the net book value is when we net off the cost. Now the cost in the second year was still the 50,000, but we now net that off against the accumulated depreciation. That's now higher, isn't it? That's now 22,500. So when I'm now working out the net book value, I've just got to be a little bit careful because I'm now netting off. It's the same basic calculation. We've still got the 50,000 original cost. That's the debit on the non-current asset cost ledger account, but we've now got accumulated depreciation of a total of 22,500. That's effectively the credit that's reducing the value of the asset. And if you net off 50,000 cost against 22,500 accumulated depreciation, I'm thinking now that the net book value of the asset is £27,500. And you see the way that the net book value has fallen further, because obviously at the end of the second year, the asset's going to be worth less, isn't it? And then on your balance sheet, you'd have other items, other things like inventories and cash, other current assets, you'd have current liabilities and such like. But can you see the way that the net book value is falling because the accumulated depreciation grows each year? So in year 3, you can imagine the net book value would fall again. In year 4, it would fall again as the asset ages, as it wears out, as it becomes worth less. Well, I'm hoping that's helped you make a bit of sense, particularly of these two crucial depreciation T accounts. I think that's where the confusion often arises. Students just get a bit confused about the difference between the depreciation expense ledger account and the accumulated depreciation ledger account. Now remember, one of them is the expense on the P&L, so as we've seen is only showing 1 year's expense at a time, whereas the accumulated depreciation is looking at the balance sheet and it's looking at the gradual reduction in value of the assets. So the accumulated depreciation is actually growing year by year by year. Well, I do hope you found that useful, and I may see you again next time. Thank you very much for listening.